When I think back on my years in the market, the wins, the losses, the hard lessons bought with real dollars, I keep circling around the same idea. The markets don't forgive sloppy thinking. They don't reward guesswork. They don't care what you or I want. They move as they move. And it's the trader's task to read them clean, without confusion, without noise. That's why I said in the previous video on trading with clarity that a man must be able to see the tape for what it is and not what he wishes it to be. Today, I want to go one step further. I want to share the 3 golden questions I learned to ask myself before entering any trade. They are simple to state, but they aren't easy to live by. And you, sitting there, listening, let me ask you, do you really pause before hitting that buy or sell button? Or do you rush in on a feeling? You see, most people in the market treat trading like a roulette wheel. They spin, they hope, they pray. That's not trading. That's gambling. And the market, unlike a casino, doesn't hand out free drinks while you wait for your luck to turn. The market takes relentlessly from the careless. Now, I'm not saying this to scare you. I'm saying it because I've been that man, eager, impulsive, hungry to prove myself right. And it cost me. It always costs. So these 3 questions I'll share, they're not theory, they're survival tools. They're the difference between being broken by the game and learning to play it with discipline. The first question I always ask is the trend clear? Doesn't matter what stock, what commodity, what index, you have to see the general drift of prices. Is it up? Is it down? Or is it sideways? And don't tell me you don't know, because if you can't tell, you shouldn't trade it. That's the truth. Would you step into a boxing ring blindfolded? Then why would you step into a market you can't read? I once bought stocks simply because they looked cheap compared to last month. What a fool's errand. Prices don't care about last month. They care about today and tomorrow. The market doesn't move because you think something is undervalued. It moves because supply and demand say it moves. Clear trend, that's the first key. But the second golden question runs deeper. Am I ready to lose? You might not like the sound of that. You want me to talk about profits, don't you? About winning trades. But profits are the result, not the plan. Risk, that's the plan. If you can't accept loss, you'll never last in this game. I've seen men with fortunes crumble because they refused to cut a loss. They told themselves, it'll come back. Do you ever whisper that to yourself? It'll come back. That phrase has ruined more traders than any bear market. Before you trade, you ask, how much am I willing to lose on this idea? And you fix it in your mind. If the market proves you wrong, you don't argue, you don't beg, you get out, fast. And then comes the third golden question, is this trade in harmony with my capital? That's the one most overlooked. You might spot a good trend, you might even fix your risk, but if the size of the trade is too heavy for your account, you're still courting ruin. A single mistake can wipe out weeks of careful work. That's not trading smart. That's greed in disguise. When I was young, I used to bet too big because I wanted to get rich quick. I thought I was smarter than the tape. But the tape is never wrong, only traders are. So I learned, always scale your trade to your capital. Protect your bankroll. Because the only thing that lets you play again tomorrow is the money you didn't lose today. Now, stop a second and think with me. How many times did you lose not because the idea was wrong, but because your position was too big? Didn't the market nudge you out on a tiny dip, only to run in your direction afterward? That's not bad luck. That's bad sizing. A trader with discipline scales correctly so he can stay in the game long enough to be right. You see, these 3 golden questions: trend, risk, capital, they aren't rules you follow once in a while. They must be carved into your trading habit, etched so deep you don't dare forget them. Because in trading, forgetting is fatal. Think about it, how many times have you told yourself, just this once, I'll ignore my stop, or this one looks too good, I'll double up. And how did that end? I know how it ends. I've lived it. The truth is, the hardest part of trading isn't finding opportunities. The tape gives you endless opportunities. The hardest part is disciplining your own impulses. That's why I keep talking about mindset. Because a trader's wealth doesn't come from a magic indicator or a secret formula. It comes from building the right habits, the right questions, the right mental posture. Wealth in the market is not the money you grab in a lucky run, it's the money you protect and compound over years. Ask yourself this: what good is making 10,000 on a hot trade if you give back 12 the next week? That's not wealth building. That's just spinning your wheels. Wealth comes when you guard the downside with everything you've got and let the upside take care of itself. That's why I keep hammering risk. I don't care how sure you feel. The market doesn't pay out for feelings. It pays out for patience, for discipline, for clarity. And remember how in that video on trading with clarity, I told you a man must cut through noise like a surgeon's knife. These golden questions are the knife. They strip away the illusions and leave only the facts. What's the trend? What's the risk? And does this trade fit your capital? Let me tell you something about emotions, because they're the enemy of clear judgment. When you watch a stock run up without you, do you feel that itch? That rush of envy, like you're missing the party? That's the market testing your nerve. And when you finally jump in late, isn't it true that's the moment it turns on you? I've chased like that. We all have. But every time, it teaches the same lesson. If the trade doesn't line up with the 3 golden questions, let it go. Better to miss a profit than to catch a loss. And fear is just as dangerous as greed. You see prices dip a little, you panic, you sell, and then the market rebounds. Fear makes you break your own plan. That's why you must settle the questions before you enter. If you know the trend, if you know the risk, if your size is right, then you can sit still. You don't fidget at every tick. You don't torture yourself with second guessing. You let the market do its work. Because a trader must sometimes sit like a statue motionless, but not careless waiting for the tape to prove him right or prove him wrong. Do you see how these questions protect you from yourself? That's the real secret. Trading isn't about outsmarting the market. It's about outsmarting your own weaknesses. The market will always be bigger, faster, stronger than you. But you can control you. That's the battlefield you fight on. And when you learn to master yourself, the profits take care of themselves. I'll tell you another truth. Most fortunes lost in the market aren't lost because the man couldn't pick a direction. They're lost because he couldn't control his size or his patience. He let a small loss grow too big. He let a winning position get cut short. He violated his own rules because of excitement, fear, or stubbornness. You ever hold on just to prove you're right? That's ego trading your account. Ego doesn't build wealth. Ego destroys it. I remember a cotton trade early in my career. The tape was clear, the trend was down. But I convinced myself I knew better. I thought the decline was overdone. I bought heavy, and when the price kept sinking, I told myself it would bounce. It didn't. It buried me. That was tuition paid to the market. Expensive tuition. But it taught me the second golden question. Always decide in advance what you're willing to lose. Never argue with the tape. The tape has no emotions, only you do. Now let me ask you this: do you have your questions written down? Or do you just keep them in your head? I'll tell you, a written rule is 10 times stronger than a spoken one. Write them, post them, drill them into your process. Because when the market starts running and your blood starts rushing, your memory gets fuzzy. You forget. But if your rules are right in front of you, they pull you back. They remind you of the cost of breaking discipline. And don't fool yourself thinking you can skip the questions once you get good. I've traded for decades, made and lost fortunes, and I still ask myself before every trade, what's the trend, what's my risk, and is this size in line with my capital? It never gets old, because the market never stops testing you. The moment you think you've graduated beyond the basics, that's the moment the market humbles you. When a man sits before the market, the very first and most important thing he must do is to determine the trend. That is the cornerstone of all trading, and it is where so many people go astray. The average trader is impatient. He sees prices moving and he feels he must be in on the action right now. But what is he really acting upon? Is it a clear signal of direction, or is it merely the noise of the tape? That's the question most don't pause to answer. And I'll tell you, the tape is filled with noise, false starts, small rallies, minor dips, moves that mean nothing in the larger scheme. If you mistake those for real direction, you'll find yourself whipped in and out of trades until your capital is gone and your confidence shattered. Let me ask you directly, do you really study the broad drift before you step in, or are you lured by the twitch of the last 5-minute bar? Trend is the heartbeat of the market. It's the river's current. And you, as a trader, are nothing but a boat on that river. You can row, you can steer, but you cannot fight the current. If you try, you'll exhaust yourself and sink. That's why I learned long ago, it is safer and surer to align yourself with the dominant trend than to think you can call the turn. Many beginners love to pick tops and bottoms. They dream of catching the exact reversal point, of buying at the lowest tick or selling at the highest tick. It's a romantic idea. But it's also the surest way to lose. The market doesn't pay for romance. It pays for discipline. When I ask, is the trend clear? I mean just that. Not do I hope the trend is up. Not does this stock look cheap compared to last year. But is the tape showing, without question, that buyers or sellers are in command? Because when control is clear, the path is smoother. A strong uptrend carries weak hands with it, lifting prices despite their hesitation. A strong downtrend crushes the hopeful, no matter how stubbornly they cling. The clarity of trend removes the guesswork. And isn't that what you want to trade, with certainty instead of hope? I've watched thousands of men ignore this simple question. They buy in a dull market, telling themselves it's about to break out. They sell in a strong uptrend, convinced it's too high. They make moves against the tape, all because they think they see something others don't. Let me tell you, the tape sees more than you or I ever could. The tape is the sum of every buyer and seller in the market, the collective mind expressed in price. To stand against it is like trying to hold back the tide with your bare hands. Have you ever tried it? Have you ever shorted a rising stock simply because you felt it had to come down? How did that work for you? The clearer the trend, the less cleverness you need. And that is a blessing, because cleverness is costly in markets. Men who try to outsmart the tape usually pay with real money for their education. But a man who simply aligns with the obvious flow, who admits the tape is stronger than his opinion, he keeps his account intact. He may not boast of buying the exact bottom or selling the exact top, but he builds his stakes steadily, because he only plays when the odds are plain. When I studied price charts as a young man, I noticed something that seemed almost too simple. Stocks that were going up kept going up. Stocks that were going down kept going down. Not forever, of course, but long enough to make a man money if he was willing to ride them. And yet, instead of believing what was in front of their eyes, most traders insisted on complicating it. They drew lines, they invented reasons, they whispered tips. I ignored their chatter and watched the movement. Price itself was the truth. If it moved higher day after day, there was demand. If it sank lower day after day, there was supply. My job was not to argue, but to recognize and act. Now, don't misunderstand me. Seeing trend is not about staring at one candle or one day's bar. That's where people fool themselves. They see a one-day rally in a declining market and call it a reversal. They see a one-day drop in a rising trend and panic. But the tape speaks in sequences, not in isolated moves. You must step back, widen your view and ask, is this the market's general direction, or just a ripple against the current? If the river is flowing downstream, a small wave upstream doesn't change that. The wise trader knows the difference. Think of the money mindset that lies underneath this. When you insist on fighting the trend, it comes from ego. You want to be the man who is right against the crowd. You want to prove your brilliance. But what good is brilliance if your account shrinks? Wealth in trading doesn't come from being right in theory, it comes from being right in practice. And practice means following the line of least resistance. Why should you wrestle with the market when it already shows you where it wants to go? There's another point. Most traders forget clarity of trend saves you from overtrading. When the market is sideways, when the tape is choppy and directionless, what does a disciplined man do? He sits, he waits, He does nothing. But the restless trader, the one who cannot accept patience, he forces trades where there is no trend, and each forced trade costs him a little more blood. Ask yourself how many of your losses came from trades you took because you felt you had to be doing something. If the trend is unclear, the best trade is no trade. That's as much a part of asking the golden question as spotting an obvious up or down drift. Let me give you a picture. Imagine you're standing on a train track. Off in the distance, you see a train coming, steam billowing, wheels grinding. Would you step in front of it just because you think it's gone too far already? That's exactly what a man does when he sells short in a roaring uptrend. Or picture the opposite. The train is hurtling downhill, rattling at full speed, and you try to stop it with your bare hands by buying against it. Foolish. The only sensible thing is to step aside or, better yet, ride the train in the direction it's already going. That is the essence of trend following. And yet, I'll ask you again, do you always trade with the trend? Or do you sometimes slip, telling yourself this time it's different? Every time I let myself believe I was smarter than the tape taught me a costly lesson. Every time I humbled myself to follow the clear current, I preserved both my money and my nerve. This is why I say the first golden question is the most important of all. Because if you cannot answer it with certainty, the other two questions about risk and capital become meaningless. They are secondary to the direction of the market. Risk management protects you once you are in a trade, but it is the clarity of trend that determines whether you should be in at all. A soldier doesn't march into battle without knowing which side holds the field. Why should a trader march into the market without knowing which side the bulls or the bears has the upper hand? Clarity in trend is also what lets you build confidence. Not the false confidence of blind gambling, but the steady confidence that comes from aligning with visible strength. When you know the trend is up and you are long, you can sit tight. You don't twitch at every tick. You don't jump out at the first pullback. You let the position breathe because you trust the current. Likewise, when you know the trend is down and you are short, you don't fear a single day bounce. You understand it's just noise against the tide. That steadiness of mind is what separates the trader who compounds wealth from the trader who churns himself into ruin. Have you ever noticed how the market tests your patience more than your intellect? It moves just enough to shake out the weak, to tempt the greedy, to frighten the timid. But if you are anchored by a clear trend, you aren't so easily shaken. You hold your ground because you aren't relying on guesses, you're relying on the visible path of least resistance. And isn't that what trading should be? Not a constant gamble, not a nervous roll of dice, but a deliberate alignment with the obvious. When you next look at a chart, don't ask yourself what you want it to do. Don't ask what your broker thinks it will do. Ask what is it actually doing. That is the only question that matters. If the answer isn't clear, then the market hasn't yet invited you in, and you must learn the discipline to wait for that invitation. Because in this game, impatience is the tax that the market collects from those who cannot wait for clarity. When I think about trading, the one truth that rises above all others is this: every trade carries the possibility of loss. It's not a maybe, it's a certainty and probability. You cannot escape it, and that's why the second golden question is so vital: am I ready to lose? It sounds negative at first, doesn't it? Most people want to talk only about winning, about profit, about gains. But the wise trader knows that profits take care of themselves when the risk is handled. Loss is the only thing you must prepare for. And I'll ask you right now, before you enter a trade, do you honestly decide what you're willing to lose, or do you simply focus on what you hope to make? The problem with most traders is they treat losses like accidents, as though they are something that shouldn't happen if only they are right. But the market is not a machine that rewards being right in theory. The market is a battlefield where even the best setups can fail. A sudden piece of news, a shift in sentiment, a wave of selling from some big operator, it can turn your perfect plan into a losing trade in minutes. If you don't accept this in advance, if you don't prepare yourself mentally and financially for that outcome, You will panic when it happens. And panic is the destroyer of trading accounts. I've seen men make small fortunes and then watch them vanish, not because their ideas were wrong, but because they refused to admit when they were wrong. They stayed in too long, holding and hoping, saying to themselves, "It'll come back." Have you ever said those words? It'll come back. They are poison in trading. A stock doesn't know you own it. A commodity doesn't care that you paid more for it yesterday. The market will not return to your entry price out of kindness. If it moves against you and the reason for your trade is invalid, you must accept the loss. That is discipline. Being ready to lose doesn't mean being careless. It means being deliberate. You size your position so that if the trade goes wrong, the loss is an amount you can accept without damaging your capital or your spirit. Because let me tell you, big losses wound more than your account, they wound your confidence, and a trader without confidence is already defeated. That's why the question must be asked before entry. If you can't stand the loss, if it's too heavy for your comfort, then the trade is too big. Walk away or reduce the size. Many beginners imagine trading is about finding a magic formula that guarantees profits. They are wrong. Trading is about learning how to control losses so they never grow beyond your reach. The profits come as a byproduct of surviving long enough to catch the right trends. I've said before, and I'll say it again, you can be wrong half the time and still make money if your losses are small and your winners are allowed to run. But you cannot survive if even one or two losses wipe out weeks or months of work. Let me ask you, how many times have you built up a nice gain only to give it all back in one reckless position? It's not the winning that destroys traders, it's the losing without limits. Every man has a point where his emotions break. For one man, it may be $100. For another, 10,000. It doesn't matter the number. What matters is that if you cross that threshold, your judgment is clouded. You stop trading with clarity and start trading with fear or stubbornness. You hold on, you average down. You do all the things you swore you would never do, and the market punishes you for it. That's why preparation is everything. Before you enter a trade, you decide in cold blood where you will get out if you are wrong. You don't decide in the heat of the moment when your pulse is racing and the tape is moving against you. You decide before, when your head is clear, and then, when the price reaches that point, you act without hesitation. That is what being ready to lose really means. It means you accept the possibility as part of the business, and you plan for it with precision. Think of it this way. A merchant who sells goods knows that not every item on his shelves will sell for a profit. Some will be sold at a discount, some may spoil, some may never move. He doesn't cry about it. He prices them, he accepts the losses as part of the trade, and he focuses on his profitable stock. Trading is no different. Some trades will spoil, some will fail. Your job is to keep those failures small enough that they don't ruin the business. But let's talk about the mindset for a moment, because it isn't just about setting stops or sizing positions. It's about truly embracing the fact that losses are part of the game. Too many traders take a loss as a personal insult, as proof they are foolish. But a loss is simply tuition. It's the fee you pay to stay in the game. When I was young, I treated every losing trade as a wound to my pride. I would fight the market, double down, swear I would prove myself right. But the market doesn't care about my pride, and it certainly doesn't care about yours. Pride is expensive, humility is cheap. Which would you rather pay for? Are you willing to accept being wrong gracefully? That's the real test. Because every trader is wrong, even the best. The difference between the ones who last and the ones who vanish is that the lasting trader takes his medicine early, while the vanishing trader clings to hope. Hope has no place in trading. Only facts do. And the fact is, the tape says you're wrong. Better to cut and preserve your strength for the next opportunity than to bleed out holding a bad position. This readiness to lose also frees you. When you know your risk, when you've already accepted it in advance, you trade without fear. You can sit calmly, watch the tape, and let the trade work. Because you know the worst-case scenario and you've already agreed to it. Isn't that a better way to operate than to sit there, heart pounding, not knowing how much you could lose. The market is stressful enough without you adding uncertainty on top. The men who ignore this golden question always end the same way. They might ride a streak of good fortune for a while, thinking they've outwitted the game. But sooner or later, a loss comes that they aren't ready for. And because they never planned for it, it breaks them. A single trade can destroy years of effort if you refuse to accept its risk in advance. And isn't that tragic, to build for so long and then lose it all in one careless gamble? I ask you again, before your next trade, will you be ready to lose? Will you mark the line in advance where you admit you are wrong? Or will you keep believing that every trade must be a winner? Because the market doesn't care about your belief. It only respects discipline, and discipline begins with acknowledging loss as part of the business. When I talk about aligning a trade with your capital, I'm speaking of a principle that has ruined more men than bad ideas ever did. A wrong idea can sting, but an oversized trade can cripple. I've watched brilliant traders, men who read the tape as clean as a book, destroy themselves not because they lacked skill, but because they forgot their capital's limits. The third golden question, does this trade fit the size of my account, is one most traders skip, and they skip it at their peril. Let me ask you directly, do you size every trade according to your stake, or do you sometimes stretch it because you feel extra sure? There's a great temptation when you see a perfect setup. The chart looks strong, the trend is clean, everything lines up, and you feel the certainty in your bones. That's the moment greed whispers, put more on it. Double your size. Go big. After all, why not? If you're right, the reward will be that much greater, and for a while maybe it works. You catch the move, you make a killing, you feel brilliant. But sooner or later, the tape turns against you. And if you've oversized your trade, one bad move can undo weeks or months of careful building. Isn't it true you've had those trades where you thought you were being bold, only to realize later you were being reckless? The market doesn't reward recklessness. It punishes it relentlessly. I've seen men with a 10,000 accounts take a 50,000 positions on margin, smiling because they caught a rally and boasting of how fast their equity grew. And then one day, a sudden reversal wiped them out completely. Not only did they lose their account, they owed more. That is the danger of ignoring the fit between your trade and your capital. The leverage looks like a gift on the way up, but it's a curse on the way down. A trader must treat his capital like a soldier treats his ammunition. Every bullet counts, and once it's gone, you can't fight the battle anymore. Would a soldier waste all his rounds on a single shot? Then, why would you put your whole stake at risk on a single trade? The man who sizes carefully always lives to fight another day. The man who doesn't, sooner or later, runs out of ammunition when he needs it most. The truth is, a trader doesn't need to risk large sums to make real money. Consistency and compounding take care of that over time. But the beginner doesn't believe it. He wants to get rich quick. He sees trading as a shortcut to fortune, and so he risks his whole stake in pursuit of speed. But speed kills in this business. Wealth comes to the man who survives, who protects his stake through ups and downs. And protecting it means never letting a single trade threaten your survival. When I learned this lesson, it was not from books or lectures. It was from losing big when I bet too heavily. I remember thinking, this trade can't miss. That thought alone should have been the warning. Because the moment you believe a trade cannot miss is the moment you've stopped respecting risk. The tape has a way of humbling that kind of arrogance. I was forced to sell, not because the idea was bad, but because I had bet too much and could no longer afford to sit through the drawdown. Have you ever been thrown out of a trade too soon, simply because you couldn't stomach the size? That isn't the market's fault, it's your sizing. When your trade is scaled properly, you can sit still, you can let the market do its work. But when your trade is too heavy, every tick feels like a knife. You panic at small movements, you sell too soon, or you hold on too long trying to justify the risk you took. In both cases, the oversized position clouds your judgment. Instead of following the tape, you are following your emotions. And in trading, Emotions are the most expensive advisor you can have. This is why the third golden question matters. Because it forces you to think about proportion. The best traders don't bet their whole roll on a single play. They scale according to their account. 1%, 2%, maybe 3% at most of their capital risked on a single trade. That way, no matter how wrong they are, they live to try again. They understand that the game is not about one trade, it's about thousands of trades over years. That's how fortunes are built, brick by brick. Not in one bold gamble, but in steady accumulation. Think about this: if you keep your risk per trade small, you give yourself breathing room. You can lose 10 times in a row and still have capital to continue. But if you risk half your account on one trade, you only need to be wrong once to end the game. Isn't survival the first goal of trading? If you cannot survive, you cannot prosper. Aligning your trade with your capital is the way you ensure survival. There's another side to this question that most don't consider. When your position size is correct, you are not tempted to meddle with it constantly.